Let me ask you a question you've never truly deeply considered, not as a passing thought, but as a foundation-shaking possibility. What if everything you've been taught about money, its nature, its safety, its very purpose, is a magnificent, deliberate, and exquisitely maintained lie? Not a random error, not a well-intentioned mistake, a fiction. A story told with such consistency, backed by such authority, that to question it feels like questioning gravity itself. You feel the cracks, don't you? In the quiet moments, you work harder, you save diligently, you follow the blueprint laid out for you. Education, career, 401k. The promise of a comfortable future. Yet, there's a persistent low-grade anxiety. A feeling that the ground beneath your financial life is not solid rock, but sand. That no matter how fast you run on this treadmill, the horizon of security seems to recede. The system, in its soothing paternal voice, tells you it's all in your head. The numbers are fine. Inflation is transitory, then tame. The dollar is the world's reserve currency, impregnable. The markets are efficient. They point to charts, to carefully curated data, to the steady hum of the stock market. But what if the most critical gauge, the one that measures the actual pressure in the boiler room of the global economy, has been deliberately mislabeled, ignored, and manipulated? For decades. What if the truth was never in a spreadsheet, but in the earth, in our history, and in the palm of your hand? Imagine this scenario, not as fantasy, but as a plausible tomorrow. You wake up. The morning light is familiar. The routine is the same. You reach for your device, a piece of technology itself dependent on the very thing we're about to discuss. You check, out of habit or curiosity, a price, and your world tilts. Not because of war, not because of a political scandal splashed across headlines, but because of a single, silent, numerical truth. The price of silver has moved, not a fluctuation, not a blip. It has decisively, violently shattered a psychological and technical barrier that the financial priesthood declared unbreakable for a generation. It didn't happen during a trading frenzy. It happened in the dark, liquid hours between closes and opens, while the custodians of the narrative slept. And in that moment of silent revelation, a lifetime of assumptions about value, about safety, about the trustworthiness of the system itself, fractures like thin ice. Because this isn't just a ticker symbol moving. This is a message. A dispatch from the tangible physical world to the abstract digital realm of finance. It is a signal sent in the oldest language there is, the language of scarcity and intrinsic worth. And its translation is terrifyingly simple. The game is up. The fiction can no longer hold. This, right here, is not a story about a medal. Let's be unequivocally clear about that from the outset. This is a story about truth versus narrative, about reality versus perception. It is a story about the most profound con ever perpetrated on the human race, the severing of money from value. And silver is the crack in the concrete where the lie is visibly sprouting. It is the canary in the financial coal mine, not just chirping a warning, but screaming with the full force of history, physics, and undeniable market mechanics. For over 5,000 years across the rise and dust of empires, from the Lydians who struck the first coins, to the Spanish pieces of 8 that built a new world from the Roman denarius to the US Morgan dollar, humanity in its diverse and often warring cultures arrived at the same consensus. Silver was money. It wasn't a decree from a king that gave it power. It was its own properties, its durability, its divisibility, its inherent gleaming value. A silver coin was not a promise. It was the fulfillment. It was a fact, as solid as the weight in your purse. Its value was its substance. Then, in the 20th century, we collectively decided to forget. We traded fact for faith. We exchanged the certainty of metal for the promise of paper. We handed the keys to this new faith, a faith in government edicts and central bank wisdom, to a class of technocrats. And their primary tool of maintaining this faith? The printing press, now digital, limitless, and operating in perpetual motion. They have printed that faith into utter oblivion, diluting its worth with every silent electronic keystroke that creates currency from nothing. Now listen closely to the official story, the ambient soundtrack of our financial lives. It is a chorus of calibrated calm. Inflation is low, they say, targeting 2%, a number plucked from economic theory, not physical law. Your savings are safe in the bank, insured by a government that itself is trillions in debt. The financial system is stable, transparent, and fair. This narrative is broadcast on every financial news network, printed in the reports of every major institution, echoed by politicians of every stripe. It is the water we swim in. Now, listen to the silence. The profound, deafening silence around certain events. Listen to the silence around the period between 2008 and 2016. In that void of mainstream scrutiny, the largest, most prestigious banks in the world, JP Morgan Chase, HSBC, and others, were caught, prosecuted, and convicted. Their crime? Not a victimless technicality. They were found guilty of manipulating the gold and silver markets. The mechanism was called spoofing. They would place massive buy or sell orders with no intention of ever executing them, creating a false impression of demand or supply, tricking the market, then canceling the orders to profit from the artificial move they engineered. They painted a false picture. They were fined nearly $1 billion. Pause on that. Market manipulation. Let the phrase dissolve its corporate sterility. It means the very institutions entrusted with facilitating fair markets were actively, deliberately distorting the single most important signal in the realm of hard assets, the price. They were lying to you, to pension funds, to nations, about the true value of real historical money. And the fine? In the context of their balance sheets and the profits gleaned from this activity, it was a parking ticket, a politely negotiated cost of doing business. Why? Why would they risk reputation and legal jeopardy for this? The answer is the keystone of the entire modern financial arch: confidence. The system does not run on truth. It runs on confidence, perception, belief. A rising silver price is a direct, observable indicator of eroding confidence in paper currency. It is the truth that, if widely understood, shatters the illusion. So it must be contained, managed, and discredited. Now layer onto this manipulation a second, undeniable truth. A truth of scale so vast, it bends the fabric of the economy. Since 2020, the money supply, the total stock of dollars and dollar-like instruments in existence, has exploded in a way that is historically unprecedented. They used soft anesthetizing terms: stimulus, quantitative easing, liquidity support. Let's use the blunt, accurate term: they printed money, trillions of dollars, created from nothing. This is not a fringe theory. It is the cold, hard data from the Federal Reserve's own H6 report. The M2 money supply chart doesn't look like a gentle slope. It looks like a hockey stick launched into the stratosphere. The basic, undeniable equation of inflation is more currency units chasing a finite pool of goods and services. Yet the official inflation number, the Consumer Price Index, remains curiously serene. It is a calculated, modeled, and endlessly adjusted figure. They change the basket of goods. They use hedonic adjustments, arguing a better TV is worth more, so the price increase isn't really inflation. They employ substitution. If steak gets too expensive, you'll buy chicken, so we'll use chicken. It is a masterpiece of statistical curation. Do you feel curated? Or do you feel the persistent grinding pinch at the grocery checkout, where a bag of groceries costs what a cart once did at the gas pump? In the shocking estimates for home repairs, healthcare, and education? One data set is a managed narrative. The other, the shrinking content of your wallet, is a physical, personal fact. Which one do you live? Which one do you trust? Here, at this precise juncture, the story converges with explosive force. While the paper and pixels world spins its tale of managed stability, the physical elemental world is screaming a different story in a language of pure necessity. Let's talk about silver not as a ticker symbol, SLV, but as a substance, an element. Ag on the periodic table, atomic number 47. It is not like money. It is, physically, the best money ever devised by nature. But its modern story is even more compelling. It is the most electrically conductive metal on the planet. It is the most thermally conductive. It is biocidal. Germs cannot survive on it. These aren't just interesting traits. They are the bedrock of our technological civilization. It is in every single smartphone, every tablet, every computer you own. It is absolutely critical in every photovoltaic cell in the solar panels we are deploying at a staggering rate to save our energy future. It is in every medical device, from pacemakers to diagnostic equipment. It is essential for the sensors in every autonomous vehicle and the components of every 5G and future 6G network. This demand is not a cycle. It is a secular, one-way ramp. It is tied directly to the arc of human progress, to electrification, digitalization, and green energy. We are not talking about demand for jewelry or silverware which ebbs and flows. We are talking about demand that is hardwired into the very future we are building. And here is where we find the first irreversible crack in the system's foundation, a crack no amount of narrative can plaster over. Since 2021, according to the Silver Institute's own meticulous data, the world has consumed more silver than it has produced, every single year. This is not a prediction. It is an autopsy of the present, a documented physical deficit. We are not living off the interest. We are burning the capital. The pantry is being emptied and no one is restocking it at the same speed. Industrial demand acts like a giant vacuum, sucking supply directly into products, while global mined output is flat. Major mines are aging, ore grades are declining, and new world-class discoveries are phenomenally rare and take over a decade to bring online. The era of easy, cheap silver is over. So we arrive at the triangle of irrefutable truth, a geometric proof of coming systemic stress. Point 1. A market with a proven, adjudicated history of active manipulation to suppress true price discovery and maintain the illusion of abundance and calm. Point 2. A global fiat currency system engaged in the most aggressive money creation in human history, fundamentally devaluing the unit of account for all those paper promises. Point 3. A critical, non-replaceable physical commodity experiencing a structural, deep, and worsening supply deficit driven by irreversible technological demand. This triangle is not static. Its points are closing in on each other. And at the converging center of this triangle is a price signal, the price of silver, that represents a force of financial physics. Suppression can only work for so long against such converging pressures. Let's press pause on this tense present. Let's rewind the tape and listen to the echo. Because history is not just a teacher. It is a prophet that speaks in patterns. This movie has played before. We have seen this act. The script is hauntingly familiar. In 1965, the United States government, in a quiet but momentous act of financial alchemy, removed silver from its circulating coinage. The Coinage Act of 1965 replaced the silver quarter and dime with copper-nickel-clad tokens. The last link between everyday money and intrinsic value was severed. That was the quiet beginning. Then came the 1970s. The illusion of monetary control shattered. Stagflation, rising prices, plus economic stagnation arrived, a phenomenon that Keynesian orthodoxy said was impossible. And silver, the abandoned money, did what it always does when faith in paper falters. It told the brutal, honest truth. It erupted from a base under 2 per ounce to a breathtaking peak near $50 in 1980. This was not merely speculation. It was a mass, instinctive migration from decaying paper promises back to tangible value. People weren't buying silver to get rich, they were buying it to stay whole. Fast forward to 2008, the great financial crisis. The house of cards built on fraudulent mortgages and dizzying derivatives collapsed. The response from central banks worldwide was unanimous and seismic. Print. The world embarked on the great monetary experiment. Quantitative easing, QE, entered the lexicon. And silver, sensitive as a seismograph to currency debasement, responded. From its crisis, lows around $9 in 2008, it surged to over $48 by 2011, a move of over 400% in 3 years. It was a direct, measurable correlation. As central bank balance sheets ballooned, so did the price of real money. Every single time trust in the paper edifice erodes, silver silently, inevitably, stands up to be counted. It is not a barometer of market fear, but of currency distrust. Now step back into this room, this moment, today. The scale is different. The money printing since 2020 makes the post-2008 era look like cautious trial runs. The industrial demand for silver makes the 1970s demand look quaint. The manipulation, though fine, has left a deep, festering wound of distrust in the pricing mechanism itself. All the historical ingredients are not only present, they are supercharged. The pressure in the system is no longer merely a financial argument about valuation. It is a physical reality. We are not just philosophically debating the nature of money. We are physically running out of the indispensable metal that underpins the modern world's infrastructure. I want you to visualize this, not abstractly, but concretely. Visualize the inventory. See it not as a line on a chart trending down, but as stacks of gray bars in a cold, vaulted room. Physical bars. Mint-sealed monster boxes of coins. The tangible stuff. These inventories, the reported deliverable stocks in key market warehouses like those of the COMEX in New York or the London vaults, are in a persistent, multi-year decline. They are the buffer, the shock absorber, and the buffer is thinning. When an investor buys a share of a silver exchange-traded fund, ETF, like the iShares Silver Trust, SLV, the fund's rules are clear. It must purchase physical silver bullion to back that share. That metal is sequestered, allocated, and placed in a vault. It is removed from the available trading pool. This is not a derivative. It is a digital title to a physical thing. And as awareness grows, these claims are multiplying. Simultaneously, in an industrial park in Suzhou, a robotic arm is placing a silver paste onto a silicon wafer for a solar panel. That panel will be installed on a roof in Arizona, where the silver will sit, effectively forever, converting sunlight for decades. That silver is not just off the market. It is gone, vanished into the infrastructure of civilization. This is the relentless one-way pull. Investment demand pulling metal into static storage, and industrial demand pulling metal into permanent, irretrievable consumption. And into this vacuum, the global mining industry is feeding a meager, struggling stream of new supply. The math is inexorable. This reality creates a moment of profound, almost schizophrenic, cognitive dissonance in the financial media. The mainstream commentary, when it deigns to mention silver, will frame it as a speculative commodity, a poor man's gold, a volatile, industrial metal subject to the whims of economic cycles. They will show you jagged intraday charts, discuss the commitment of traders report, and mention silverware demand in India. They are analyzing the flickering shadow on the wall of Plato's cave. We are describing the solid object casting the shadow. They are obsessed with the ephemeral price on a screen. A price we have established is subject to manipulation. We are focused on the irreversible, physical disappearance of a critical elemental resource into the guts of our technological society. Which conversation is anchored in reality? Which one will matter when the physical shortage can no longer be papered over with derivatives? Let's talk about the endgame, the logical terminus of this trajectory. The deficit does not resolve. Suppose it continues, as analysts from firms like Metals Focus predict, for the foreseeable future. Year after year, the gap widens. The warehouse inventories drain from thousands of tons to hundreds to critically low levels. The physical market becomes tight, then taut, then brittle. Then one ordinary Tuesday, a major procurement officer for a top 5 solar panel manufacturer, tasked with securing a 500-ton annual supply contract, makes calls to the usual bullion banks and dealers. The answers are hesitant. The premiums are staggering. The delivery dates are uncertain. They cannot secure the volume, not at anything close to the quoted spot price on the screen. A real physical delivery squeeze begins. This is not a hedge fund piling into futures contracts. This is the literal engine of the global energy transition, needing a critical raw material to function and finding scarcity. The paper market, a towering skyscraper of futures contracts, options, unallocated accounts, and ETFs, is built on the foundational promise of metal delivery. It now collides with the brick wall of physical unavailability. In that moment of reckoning, the paper price and the physical price violently converge. It will not be a trend, it will be a dislocation, a repricing of reality itself. Now imagine the psychological cascade this triggers. Silver decisively breaks above $30, a resistance level that is held for a decade. Media, technical breakout. It powers past $50, the nominal high from 1980 and 2011. Media, a speculative bubble in industrial metals. It reaches $75, then $100, numbers that sound absurd today. The narrative, forced by the sheer weight of price action, begins to pivot. What is driving silver becomes a lead story. The sleeping giant, the general public, the retail investor who has been conditioned to think only in terms of stocks and bonds, awakens. They see parabolic charts. They hear tales of dealers with empty shelves, of month-long waits for coin deliveries. They remember family lore about silver coins saved during the Great Depression or the 1970s. The most powerful engine in financial markets, the fear of missing out, FOMO, ignites, but this time it's fused with something deeper, more primal, the fear of currency destruction. The rush begins. But by this stage, the physical metal is already scarce. The premium you pay to actually take delivery of a bar or coin might be 30%, 50%, 100% above the soon-to-be irrelevant spot price. The disconnect between the paper illusion and physical reality becomes a yawning chasm. This is the moment you will know, in your bones, that the system is not just strained but broken. This leads to the inevitable, skeptical question, the elephant in the room. If this thesis is so compelling, so logically airtight, why isn't every institutional investor on the planet already all in? Why aren't pension funds, university endowments, and sovereign wealth funds shifting 10% of their portfolios into physical silver? This apparent contradiction is, in fact, the final beautiful piece of the puzzle. It is the reason the opportunity still exists. The system is structurally designed to ignore it. The entire institutional investing world is a world of benchmarks and career risk. A portfolio manager at a major fund is judged quarterly against the S&P 500 or the Barclays Aggregate Bond Index. Deviating significantly from the herd to buy a niche, non-yielding, barbarous relic is professional suicide. If you're wrong alone, you're fired. If you're wrong with everyone else, you keep your job. Silver is not in the major indices. It is a tiny, fractional market, often mocked by mainstream economists. It is the perfect blind spot. Furthermore, the long history of manipulation has itself become a psychological trap for the sophisticated skeptic. They say, the silver market is manipulated, it's rigged, so I won't touch it. They are factually correct, but logically bankrupt. The correct deduction is, the market is manipulated because the truth it would reveal is too dangerous. Therefore, the manipulated price is a distortion, a gift, an artificially capped spring storing immense energy. Your edge is not supercomputers or insider information. It is simply the perspective to see the manipulation not as a reason for dismissal, but as a symptom of profound systemic importance and a temporary dam holding back a flood. So, what do you watch? Ignore the daily noise, the tweets, the breathless commentary about every $0.50 move. Focus on the slow tectonic signals. Watch the monthly inventory reports from the COMEX and LBMA. Track the annual supply-demand balance figures published by the Silver Institute and Metals Focus. These are reports on physical reality, not trader sentiment. They are the tide. The daily price is the choppy, irrelevant waves on the surface. The tide is going out, and when it turns, the reversal will be swift and definitive. This brings us inevitably to you, to the deeply personal stake in this intellectual and financial discovery. This is not primarily about speculation, about turning a quick profit. This is about sovereignty. It is about preservation. It is the conscious act of opting out of a game whose rules are deliberately skewed to silently transfer your wealth, your labor's stored value, from your pocket to the issuers of debt-based currency. Holding physical silver outside the banking system is a silent, potent vote of no confidence. It is the repatriation of a portion of your wealth from the digital, promises-laden, counterparty risk-filled system back to the tangible, atomic, final settlement world of elemental value. It is the ultimate insurance policy. The premium is the opportunity cost of not having that capital in a soaring stock market until that market corrects. The payout is the preservation and potential significant increase of your true purchasing power through the coming storm. Now, honestly, consider the alternative narrative. The one where you dismiss all of this as alarmist nonsense. You trust the calm, credentialed voices. In this world, several miracles occur in unison. Geologists suddenly discover multiple massive, high-grade silver deposits that are cheap and easy to mine. The green energy transition miraculously decelerates or finds a perfect substitute for silver. Millions of investors in ETFs suddenly decide to sell en masse, flooding the market with vaulted metal. Central banks and governments globally execute a flawless, politically painless reversal of decades of monetary expansion, raising rates, destroying currency, and restoring discipline, triggering no social unrest. Banks operate with angelic transparency. Inflation gently fades back to 2%, and the dollar's purchasing power magically restores itself. Which future requires more suspension of disbelief? The one governed by the immutable laws of supply and demand, historical precedent, and human nature? Or the one that requires a host of powerful, fallible institutions to perform a ballet of perfect self-sacrificing virtue for the first time in history? The clock is not stopped. It is ticking faster. The deficit accumulates with every electric vehicle that rolls off a line. Each uses up to 50 grams of silver, with every new solar farm commissioned, with every 5G tower erected. The money printer may switch from high to medium, but it never ever goes to reverse. Each act of price suppression through paper derivatives doesn't eliminate the deficit. It merely stores the pressure, like compressing a spring. You now stand at a point of inflection, armed with a context that the vast majority of the market, by design, by inertia, by training, chooses to ignore. Therefore, I will leave you not with a hyperbolic prediction, but with a final, syllogistic deduction of pure logic. We have a finite planetary resource, critical to the technological advancement and arguably the survival of modern civilization, being consumed at a rate that permanently outpaces its replenishment. Concurrently, we have a global financial system that creates infinite digital claims on all finite resources, debasing the unit of account with abandon. This is a profound, unresolvable contradiction, a mathematical and physical impossibility playing out in slow motion. One side of this equation must break. Either human technological progress halts, a dire and unlikely scenario, or the price of that critical, vanishing resource must rise catastrophically and permanently to reflect its true, terrifying scarcity. There is no third door. Silver is not a prophet. It is a mirror. It is merely reflecting back, with the cold, impartial logic of physics and the market, the consequences of choices already made by central banks and governments. Your choice, the only one that remains, is stark. Will you heed the message whispered by history and screamed by the mounting physical deficit? Or will you continue to listen, comforted and compromised, to the lie? The metal is silent, but its verdict will be deafening.